makers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Tom McKenzie in London, in for Francine Lacqua. And US stocks have extended their record high, as we mentioned yesterday, ahead of a key week, of course, for earnings. Today, futures a little softer, as I mentioned. Let's bring in Bloomberg's Valerie Teitel right now for a gauge on these markets. Valerie, what is the next catalyst? It is all about the earnings story. What are you watching?
Yeah, it might all be about the earnings story, and especially how the tariff-related earnings story goes from here. But the S&P 500 closing above the 6,300 level for the first time in its history. We're now up 26% since those lows in mid-April. Now, note the breadth of this rally, Tom, still has not been that great. Only around 8% of S&P 500 stocks are trading around their 52-week high, their 1-week high. But the one thing I found really interesting is what seems to be driving this latest leg up in the equity market is a dampening of volatility. We've gone nearly a month, Tom, without a plus or minus 1% swing in the S&P 500. It just seems like the equity market is getting used to this kind of policy uncertainty. We're not seeing these kind of wild swings that we did see earlier in the year. So this dampening of volatility is allowing us to reach these new record highs. I also thought it was interesting in yesterday's price action that, yes, we did end in the green on the equity market, but we were seeing these kind of frothy stocks really take a hit. In yesterday's session, things like non-profitable tech were down quite a bit. We also had things like the SPAC index, the retail favorites, the most shorted stocks did end their rally yesterday, maybe pointing to the fact it might be a bit harder to notch these record highs moving forward. But the focus does shift to earnings. Now, we do have one of the big auto names reporting earnings today. That's GM reporting before the bell. With this focus now being on the tariff-related sectors, I think we could have a shift in narrative, either of one of corporate resiliency against these tariffs or once of companies struggle to adjust. Tom.
OK, the tariff pass-through may be in focus, particularly with the automakers, as you say. Subdued volatility, at least for now, when it comes to these markets, and a lack of bad breadth in these markets. Bloomberg's Valerie Teitel, thank you very much indeed. Maybe the volatility will pick up if there's additional pressure on the Fed. We continue to see that. The US Treasury Secretary calling now for a review of the decision to renovate parts of the Federal Reserve's headquarters in Washington. In a post on X, Scott Bessent said all of the Fed's, quote, non-monetary operations should be looked at, adding that significant mission creep could jeopardize the Fed's core monetary policy mission. Bloomberg's EMEA news director, Ros Madsen, is here with the details in terms of what we've been hearing from Scott Bessent. It seems like Scott Bessent is now joining other members of the administration in putting pressure on Jay Powell, and someone that clearly the markets has seen as something of a protector when it comes to the question of Fed independence and particularly Jay Powell's role.
Well, that's right. And he's been very vocal in the need to preserve the Fed independence, but also he's very attuned to the need to be in lockstep with his boss, Donald Trump, on things. I mean, Donald Trump has made it clear that he sees Bessent as staying in his role, but it wouldn't be out of bounds for Bessent to be somewhat auditioning to replace Jay Powell even. But what we've seen, the experience of Elon Musk is quite telling. You don't get ahead of your boss, and you don't certainly be driving the public agenda. And these were reports that Bessent had privately briefed Donald Trump against attempting to fire Jay Powell. Donald Trump came out publicly and said, hang on, no one briefs me and tells me how things are. So a sense that, Bessent is reading the room there and very much wanting to be, at least publicly, in lockstep with Donald Trump, being critical of the Fed, questioning this renovation, but also interestingly saying, like, has the Fed got over its skis in general and in how it's interacting on non-monetary policy areas? Is it extended its remit? He was very vague about that, but a sense that perhaps it's stretching itself too far. And the question of, should we assess whether the Fed's been successful at all? I mean, I don't know how you measure the Fed and how successful it's been, but certainly the language is very much in lockstep with Donald Trump.
All of this happening at a time, of course, where the Treasury Secretary is also dealing with trade negotiations. And we're about 10 days away, of course, from that August the 1st deadline on those additional tariffs. Where do things stand on that front, Ros?
Well, we know that negotiations are happening at quite a frantic pace. Japan was there yesterday. We know talks are coming with South Korea and other nations. It's interesting to see in Asia, particularly Japan, South Korea, Malaysia, still those fundamental questions of these bespoke, important industries that are really part of the national psyche in these countries. So you've got beef, and agriculture. For example, rice in South Korea. You've got agriculture again in Japan, rice. We just had a very tricky upper house election there for the government. In Malaysia, it's about not wanting to cut subsidies for fishermen because fishing is so much part, not of the economy necessarily, but of the national psyche and therefore of politics. And if you've got one eye on your voting blocks, you're going to be very attuned to that. So the trick is, how do you, in a way, give concessions to the US that don't give away the protectiveness of those sectors? So perhaps you talk about joint investment in energy instead. Let's do gas projects together. Let's build ships together. But let's not really come at stuff that's fundamental like beef, rice and fishermen.
OK. Ros Madsen, thank you very much indeed. Our EMEA news director on some of the sticking blocks and still the stumbling blocks, I should say, and sticking points around these trade negotiations as we count down, of course, to August the 1st. Ros, thank you. Joining me now for a deeper dive in terms of the economic impact of tariffs, but also AI as well, is Morgan Stanley's Chief European Equity Strategist, Marina Zavolock. Marina, thank you for joining us around the desk. And we will get to this really fascinating piece of research that you and the team have been doing in terms of AI adoption in Europe and how to position, how to invest around that theme. But I want to start more broadly before we get there in terms of what we're seeing across these equity markets. Today, a little bit subdued, maybe looking for the next driver, the next catalyst. Are these equity markets, the US, Europe, given the gains that we've seen year to date, are they driven by fundamentals at this point, or is this a momentum trade?
Under the surface, there's a lot of momentum. So we're seeing, we prefer also those kind of AI-exposed sectors, the sectors that have really worked already this year. And the sectors that haven't worked this year are underperforming. So the momentum is continuing. The biggest feedback I've had on some of our sector picks has been, well, it's obvious, but that's what's happening. The obvious is continuing to work. And
like defense, for example?
Defense is a little bit more choppy, but like AI in particular has been a huge theme this earnings season in the US, in Europe as well.
Do you think, on the question of momentum, does the momentum swing back? European stocks had this outperformance. There's been a bit of a catch-up now. Both the S&P 500 and the Stocks 60, I should say the Stoxx 600 is currently up about, though both indexes up about 6 or 7% year to date. So it's been a bit of catch-up for the US stocks. Does the momentum swing back, with that focus on tech, does the momentum swing back to the US in the second half of this year?
Yeah, it's already begun.
Right.
So the momentum has swung back to the US. We think that continues for now. The US just has much more AI exposure than Europe does. So that will continue to drive things. And then that's coming through in earnings as well. So at this point, Europe has almost 0% earnings growth. In local currency terms, the US is 9%. So that divergence.
How much is priced in on tariffs when it comes to the 0%, almost 0% earnings growth for European stocks?
I think 10% is priced, 10% tariffs. If we get higher than that, then we're going to get some downgrades. But the tariffs exposure in Europe, something we've been saying a lot, is quite idiosyncratic. You have about 6% of revenues in Europe that are directly exposed to tariffs, and then much more broadly in terms of the kind of lingering uncertainty and direct effects of tariffs.
Does stimulus coming through from Germany predominantly and some others, does that offset the tariff impact?
Not yet. That's the problem.
Is it a 2026 story?
You'll start to see the trickle through into earnings in 2026, but more kind of in the back end of the year.
Yeah.
And then really it's actually a 2028 story because a lot of the projects have 3-year lead times. So you'll see more of the earnings impact in 2027, and then the big blowout in earnings will only come in 2028 for Europe.
Okay, really interesting. So a bit of a pushback in terms of the time frame.
This is part of the problem of the relative performance.
The relative performance. Okay, 2028 maybe is what you want to be thinking about. On that return on investment, it's been a key question, hasn't it, around the investment into AI. But you say that the adoption in Europe is happening now in terms of AI across different sectors and different companies, and you are starting to see a material impact in terms of ROI.
Yes. Yeah, so far, obviously you can quantify the benefits to enablers really easily. So that's what the market's been focused on. Adoption, like for myself, for a strategist, it is very hard to quantify what kind of benefits you're getting from adoption. Even at the company level, it's hard for analysts to quantify that. What we've done recently is we've taken this mapping Morgan Stanley has done 4 times, just published the latest version, and we've looked at adopters in Europe and how their earnings and their returns are trending over time. and comparing that to the overall market, to their respective sectors. And basically, you are starting to get evidence from a returns perspective, from an earnings perspective of outperformance of AI adopters. So I can, for the first time, say that there's very credible evidence that ROI for adopters is finally coming through.
Which sectors are standing out? How sector agnostic is this? Or is it in specific sectors where the adoption is happening more rapidly and they're starting to see that ROI?
Yeah, there are some sectors with more breadth of adoption in Europe. So financials is a sector with a lot of adoption, banks. Software obviously has a lot of adopters, business services, more services sectors. But it's quite broad. And what was interesting when we were doing this analysis is that we actually put together a list of 20 stocks that are leading the way on adoption. And when I went to our different sector analysts, they all said we have one, maybe three stocks in our sector that are really ahead of the game. So within sectors, you have some dispersion as well.
OK, so how do you play that AI adoption story in Europe then?
It's idiosyncratic. So our group of adopters that we analyzed in the note, there are 120 stocks in Europe that we cover that have at least moderate exposure, according to our analysts, to either adoption or adoption enabling. And we also we screen for neutral to high pricing power because we want them to be able to hold on to the margin gains. So 120 stocks, you can look at a group of those, or we have a list of 20 stocks that we published in our note, which are, as I said, within the sectors, the leaders. But you can't do it really through the index.
OK. What about those European companies that are being disrupted themselves by AI and are vulnerable to AI?
Yeah, that's a really good question. So now that question is coming up more and more. We've also looked at disrupted stocks. So far, in our coverage of over 500 stocks in Europe, there are only 4 stocks that our analysts have categorized as disrupted. Now, that might be a little bit optimistic. So there are also 30 stocks that are categorized as wildcard. So the analysts are not sure, but they could be disrupted. It's not completely clear. And if you combine wildcard and disrupted stocks, and you look at their earnings trends and their performance, basically their earnings are underperforming definitely the AI adopters and even the European index in the last year. And they also are derating.
OK, so there are a basket of stocks.
You have a significant divergence between those adopters and the disrupted and wildcard.
What is the adoption in Europe looking like versus the adoption in the US? Because sometimes I speak to people, CEOs of tech startups here, and they say if they've got revenue stream in the US, they're seeing much more rapid adoption in the US, shorter time frames. The CFOs of their customer companies, much more willing to spend and take a gamble and take a risk, essentially, on their products. Is that playing out? What is the adoption story, Europe versus the US right now?
It depends if you look at as a percentage of companies in Europe or as a percentage of the index weight. So if you're looking as a percentage of the index weight, our large cap multinational companies are adopting as quickly as your standard large cap US companies. The point we've made in our research and we've been making is that the US has obviously a lot more enablers than Europe does. So over 40% of the index in the US on a weighted basis is exposed to enablers. And those have been the stocks that have seen the fruits of AI first and have really benefited. Europe has much fewer enablers, but that also leaves us a lot more room for adoption exposure in our index. So our adopter exposure in our index is 70% weight of the index. So if you're starting to broaden out, you get AI diffusion, starting to see ROI come through for adopters, then Europe really stands to benefit. And then our adopters, they trade at almost a 30% discount to the equivalent adopters in the US, despite having very similar earnings trends.
OK, from the enablers in the US to the adopters in Europe and that valuation play as well. Marina, thank you very much indeed. Really interesting piece of research and work that's been done at the Morgan Stanley team, of course. Chief European Equity Strategist Marina Zavolock with a look at how AI is being adopted and that material impact now in terms of ROI. Coming up, as German companies pledge to invest billions of euros in new projects, will it be enough to revive Europe's biggest economy? We're going to talk to Allianz's senior economist about that. That's coming up. This is Bloomberg. Welcome back now. More than 60 of Germany's leading companies have pledged to invest at least 100 billion euros in new projects to help lift Europe's biggest economy out of stagnation. The corporate vote of confidence comes as Chancellor Friedrich Merz's government has seen its lead narrow in recent polls. Let's bring in right now Jasmine Groschl, senior economist at Allianz, for a view on the German economy, the stimulus focus, of course, the fiscal spend and that investment impulse. Jasmine, thank you for joining us this morning. When does that spend on the private level and the public level, the state level, start to have a material impact on the growth trajectory of Germany?
Yeah, so it will start to have an impact this year, but only marginally. But really, it will have an impact for next year. Also, on the government side, with the higher depreciation rates, with the tax cuts on R&D. So we're bringing up government investments, but we also will bring up private investments with that. The depreciation rate itself could actually add 1.1% of more investments, and with that, about 0.2 percentage points of GDP to next year's growth rate.
What would tariffs do to that projection, Jasmine? Tariffs of 30%, of course, have been threatened by President Trump. We're counting down to the deadline on August the 1st. What assumptions are you making about ultimately where those tariffs settle as you try and project forward on this German economy?
Yeah, so I think we have to see what happens on August 1st. Currently, we count on the 30% tariffs that have been announced. This will hit the German economy hard, obviously, especially in key sectors, machinery, pharma, auto, and chemicals. But we believe that the EU will actually strike a deal with the US and finally then settle down on a rate around 12%, which is still much higher than what we had before. Even before Liberation Day, they already went up from about 1.2% to 4%, but 12% is really hard and it will hit the European economy, especially the German economy, which is one of the most exposed ones to the US besides Ireland.
Yeah, indeed. What would 12% tariffs then mean for the labour market, for jobs? How many jobs would be hit in that scenario?
Yeah, there's a lot of value add in these exports and a lot of job exposure in that. So what we count is that there could be around 500,000 jobs basically at risk within the EU, not only in Germany, but overall in the EU. And that could actually drive up the unemployment rate across the EU between 0.1 and 0.4 percentage points if this actually hits the EU on a longer term basis.
OK, so up to 500,000 jobs at risk, potentially across the EU. Jasmine, when we think about the tariff impact and to what extent that 12%, and that's the forecast from you and the team at Allianz, to what extent that 12% could be offset by the spending that's coming through from Germany, how do you think about that offset that we may see?
Yeah, so for Germany, we see that this year, basically, if the tariffs hit, it will be basically half a year. And then we have the aluminium and steel tariffs, the auto tariffs, and potentially also the pharma tariffs now. So this year, basically, the spend from the government, so the higher defense spending, the stimulus they bring from the higher depreciation rate of 30%, this will basically more or less offset the changes in the tariffs, so in the higher trade costs. So basically a little bit more of growth, but just 0.1 percentage point more is offset basically to the trade war effects. And then for next year, we see basically a trade effect on growth of about minus 0.5% for Germany. And the growth stimulus is larger. So only from the infrastructure package, for example, we see about 0.7 percentage points on growth added. So overall, we land around 1.3%. So the government spending, the fiscal stimulus will basically drive up the German economy, but the trade war will drag it down, but not fully.
OK, really interesting that the fiscal stimulus will do more in terms of reviving the growth picture for Germany and will more than offset the tariff impact. What are we, in terms of how we're thinking about how the changes and how the reform agenda is pushed through in Germany? I speak to German CEOs and they'll say, yes, the fiscal spending, the spend on infrastructure, the spend on defence is welcome, but we want to see changes implemented. It's about implementation and it's about structural reform. Are they going to be matching the spend with structural reform?
So absolutely, that is one of the key topics. So the fiscal stimulus can actually drive up the economy in the short term, but it doesn't help in the long term, especially with the green transformation, with demographic changes. So currently, we don't see too much of structural reforms, meaning the labor market, the health system, and the pension system. And this is really something that we feel is missing at the moment, and where more has to come from Berlin, from the new government, to actually also pick up potential growth in the future, because basically the wave of the demographic change will only come towards 2029. And until then, these short-term fiscal stimulus can help, but they can't offset all these structural changes, and this is still missing.
OK, so the need for structural reforms to power longer-term growth for Germany. As we think about a stronger German economy, even in the face of those additional potential tariffs, Jasmine, what are the ripple effects? Which other European nations are likely to benefit the most from that uptick in spend and growth in Germany?
Yeah, so we definitely have other nations that are intertwined in the supply chain. So Northern Italy is one of the regions that will benefit from a stronger Germany, Austria, obviously, but also Eastern European countries like Poland, Hungary, and Slovakia, which are strongly connected to the German market overall, but especially also in the auto supply chain. So they can benefit from a stronger Germany in general. But from the fiscal stimulus, for example, from the infrastructure package, we also see the Eastern European countries potentially to benefit, because there's capacity constraints on the construction sector in Germany, especially also on civil engineering, but also in services related to construction. And these could basically come from Eastern European countries, which could then see stronger growth because of a stronger Germany. But overall, I have to say all of Europe would basically benefit from a stronger Germany because of the trade connections we have in the single market.
OK, Jasmine Groschl, senior economist at Allianz, mapping out the future growth picture for Germany amidst, of course, the tariff uncertainty and what it could mean for the broader Eurozone. Thank you. Coming up, Norsk Hydro has adjusted second quarter earnings, beating estimates. We're going to talk to the company's CEO. That is next. This is Bloomberg. Good morning. Welcome to the Pulse. I'm Tom McKenzie in London. These are your top stories. Stocks waver ahead of mega cap tech earnings this week after yet another Wall Street record, as trade uncertainty weighs on markets. US Treasury Secretary urges a review of the Fed's building renovation and policy mission creep as Washington ramps up the pressure on Jerome Powell. Plus, the UK borrows billions more than expected in June in another setback for the government's efforts to shore up the public finances. To earnings now, Norsk Hydro shares, one of the biggest gainers on the Stoxx 600 this morning. This as the aluminium supplier reported adjusted second quarter earnings ahead of analyst estimates. We can speak now to the CEO of Norsk Hydro, Eivind Kallevik. Eivind, thank you very much indeed, sir, for your time in the back of these earnings. Obviously, there's going to be a focus in terms of the tariff impacts. You are exposed at least to the headwinds around trade. You've come through with this beat. What are you seeing in terms of the tariff impact right now across the business?
Well, I think first and foremost, very happy to deliver another very strong financial quarter, given all the market uncertainties, as you point to. Our company is very little directly impacted by the tariffs as such. We're mostly European, and then what we do in the US is mostly, let's say, based on sourcing locally produced raw materials and then selling to local markets in the US. So not much of a direct impact, more concerned than about maybe indirect impacts in terms of general economic growth in the world.
And on that point, are you seeing your industrial clients, are you seeing any evidence your industrial clients are starting to pull back and be a little bit more conservative as a result of some of those challenges, some of that volatility?
We're actually quite happy with the downstream markets as we see them now in Q2 and the pace that we have into Q3. Seems like markets have been bottoming out, and we actually expect a little bit of uplift in Q3 compared to Q3 last year. So slightly optimistic, at least in terms that we've seen the bottom so far.
You're a key supplier, of course, to the auto market. We know that it's challenged on a multiple factors and multiple different levels, and particularly around tariffs. What is the auto sector looking to you like right now?
So we are exposed to many markets. So for us, the building and construction market now seems to be picking up somewhat. On the automotive side, the headwinds seems to be slowing down at least. So again, not in positive territory, but at least the negative trend that we saw for the first half seems to be slowing down somewhat going into the second half.
And what steps are you and the team putting into place specifically across the business in this time of heightened uncertainty on the trade front?
So we're really addressing this in two ways, because for us as a company, it's always been important to influence what we can influence ourselves. What we've been looking at now hard for in the second half is really the capital expenditure, so the investments that we plan to do. So we plan to take that down by 1.5 billion Norwegian kroner, down from 15 to 13.5 billion for the year, which is important in terms of cash flow. The second part that we're doing is also that we are reviewing what you can call white-collar workforce that we have in the company to ensure that we have a workforce that is aligned with the activity levels that we have also going forward.
What does that give us? Give us some details then in terms of what that means. When you focus on the white-collar workforce, the office workers across the business, how many jobs do you expect to reduce? What does it mean for headcount in the next 12 months, for example?
Sure. So that is, of course, the big question that we haven't announced yet. What we have done so far is really to establish a hiring freeze, which we did about a month ago. And then we will spend the summer reviewing at what level the future workforce should be. And then we will announce that when we come back at some point after the summer break.
OK, so we watch for that detail after the summer break. In terms of the stimulus, we've been talking about the stimulus story in Germany this morning with our guests. Are you starting to see the impact? Do you expect that additional spending on infrastructure, on defence in Germany to have a material impact in terms of as a growth demand driver in the next 6 to 12 months, or maybe further out into 2026? Are you starting to position for that?
I think this is a really important initiative for Europe and obviously for Germany in particular. And Germany should be the growth engine, so to speak, in Europe, given its size. So it's a very important initiative, but I think we need to see this come into fruition. It needs to come into activities. We really haven't seen it yet. Probably, and we expect to see something at the tail end of 2025, but more likely well into 2026 before we see the impacts of the planned spending.
OK, more of a 2026 story for you and the team at Norsk Hydro. Do you expect it to be a significant demand driver, though, by that period of time?
I do. Aluminium goes into a lot of different products, whether you talk about energy transition in terms of cables, solar parks, wind parks, whether you talk about infrastructure investments, you will find aluminium in all of these applications.
When it comes to the US market, you say that you've seen a tick up in terms of order bookings among some of your clients, or in that part of the market at least. How big of an increase are you seeing in terms of bookings in the US market?
So we see an uptick. So we are careful in guiding sort of specific numbers, but we see an uptick coming into Q3. Driven from two things, we believe. One is that the economic activity in isolation in the US is holding up quite well. And second part of this, we are the biggest extrusion company in the US. And as US are cutting imports of extrusions from overseas, we will be a natural company to go to replace those orders with domestically produced goods.
OK, so that's the US market. In terms of the breakdown, the particular units of the business, there was a lot of focus from the analysts out there on the extrusions division. So poles, tubing, building systems. You're restructuring that unit. You're making some changes. Where are you in that journey?
So that's something we will continue to evaluate. We have curtailed and mothballed some activities in Europe, and we will continue to monitor that as we see how demand is evolving. Today, we have more capacity than what we produce, so there's still good room in the production portfolio that we have to pick up any new orders coming in as we see it.
Alumina prices obviously have fallen. Do you have a steer in terms of a trajectory? What are you factoring in? What estimates are you making about alumina prices through the end of the year and into 2026?
Yeah, I think it's important to remember why alumina prices spiked in fourth quarter of last year. That, of course, was driven primarily by disruptions on the production side. Those disruptions have been remedied. There are some curtailed plants or closed plants, so they will be out. But then you have new plants coming on stream during 2025 and into 2026, which means today that we have pretty much a balanced market. So the spot price that we have today probably is also what we would look for in the third quarter, unless there are unexpected events, again, as we saw last year.
Okay. Eivind Kallevik, CEO of Norsk Hydro, on the back of those earnings. Coming through with a beat. Sir, thank you very much indeed for your time. Now to Japan, where Prime Minister Shigeru Ishiba has vowed to stay in office following a second election setback in less than a year. Ishiba says he will now put all his efforts into negotiating a trade deal with the US. For more, let's bring in Bloomberg opinion columnist Groschl Reedy for a take on this. Can Ishiba then remain in his job given the challenge that his party faced, the LDP, in these elections? No longer has a majority in that part of the parliament. How does he stay as prime minister given his eroded authority?
It's a very good question. I think the short answer is that there aren't a huge list of successors or people who want the job, particularly given the challenges that the party is facing and that the country is facing when you consider the issue of tariffs that are about to come into play in the coming days. Long term, it does seem unlikely that Ishiba is going to be able to hang on. As you said, he has said that he's going to stick with the job, but we've seen in the past, just as recently as a year ago, that can change very quickly if he loses internal support or if enough dissenters within the party start to draw out their knives and look for a target. At the end of the day, this election has been an absolute disaster for the LDP, and at some point he is going to have to take responsibility for that.
Okay, well, we'll see when that point is and what that looks like. Meanwhile, he's saying that he needs to be at the helm during these trade talks with the US, of course, as we face up to August the 1st as the deadline. We know conversations are continuing. Has there been any progress? Is this Prime Minister, Mr. Ishiba, likely to get a deal in time?
I think the short answer is that there hasn't been much progress at all. I was one of the people who thought that Japan would get, or would be one of the first countries to get, a good deal from the US. That hasn't transpired at all, and indeed Japan is being treated in a manner that you would not expect such a close ally and security partner of the US to be treated in. Ishiba has not been able to form a relationship with Trump the way that the late Shinzo Abe was during Trump's first term in office. And as the deadline is approaching, maybe that gets pushed down the road again, as has happened in the past. But there doesn't seem to be any, progress between the two parties. I don't think all of that is on Ishiba. I think some of the stuff that the US side is saying, particularly about, auto sales to Japan, just don't really have any grounding in reality. There's not really much that Japan can do about that. But certainly Ishiba's inability to forge a relationship with Trump doesn't appear to have improved prospects for a deal in the near term, and maybe what the country needs in order to get that deal is new leadership at the top.
Okay, Bloomberg opinion columnist Groschl Reedy, thank you very much indeed on the challenges for the embattled Prime Minister of Japan, particularly as he faces up to those trade conversations and the countdown to that deadline. Groschl, thank you. To the UK now. Government borrowing here came in worse than forecast in June, with a surge in debt interest payments, sending the budget deficit to £20.7 billion. It is, of course, another setback for Chancellor Rachel Reeves that will fan speculation over potential tax hikes to shore up the public finances. Bloomberg Opinion's Rosa Prince is with us for the details. In terms of the borrowing figures, though, how damaging is this for the Labour government now? It is in increasingly challenging territory when it comes to the fiscal picture of the UK.
Yeah, it just seems like every day brings more bad news for Rachel Reeves, doesn't it? The political summer starts after today, and I think that when Parliament rises, and I think they'll all be glad for a break, because yet another problem on Rachel Reeves' desk. She's had blows to her chances of cutting public spending. If you remember those big rebellions from the Labour Party over plans to curtail welfare spending, to cut benefits for pensioners, and the sums just don't add up anymore for her. This figure that came in, it's a lot more than the OBR, the Office for Budget Responsibility, had predicted, and it's fueled by spending on debt payments, which is what she's been warning about all along, and trying to get the books to balance. The thing that they've been sort of putting all their eggs into is growth, but as we know, growth has been pretty insipid as well. So I think pretty much everyone was expecting tax rises to come down the track in the October budget, and now that almost seems nailed on.
OK, and to your point, every day seems to be a new piece of news suggesting that tax rises have to be locked in now for this Chancellor, given that fiscal hole that she and the team faces. Meanwhile, on a longer-term story, arguably, we have Reform UK, of course, coming out, and they are polling in line with or above the governing Labour Party, alongside the Labour Party, not coordinated, of course, but both key parties, of course, now talking about possibly, or at least opening the door to an extended retirement age. We may all be working a little bit longer, partly because of that drag on the finances.
Yeah, well, this would be something that perhaps the government could do to sort of get some money in the door. So Liz Kendall, who is the Work and Pensions Secretary, yesterday announced that she is exploring the option of extending or raising the pension age. Now, this is something that the government does review anyway, every 6 years. But the fact that she did it with a big speech, that she talked about the fact that we cannot afford our retirement savings as they are. Pensioners, so the leading charity on this, have estimated are already going to retire with about £800 a year less than they think they are, and that we all need to work for longer and save more during the time that we're working. So at the moment, the pension age is already due to rise to 67. That's coming down the track in 2026. After that, it's due to go up to 68. That's not coming until 2024. Could they bring that forward? That would actually possibly save them as much as $25 billion a year. Could they even go to 70, which is what we've just seen Denmark announce? Now, I think for that to work, we all need to be healthier longer. And although our age expectancy, life expectancy is rising again, it took a dip during COVID, it's not rising at that much of a rate. So, and I think the other thing that we're playing on politicians' minds, on Rachel Reeves' mind, is does she really want to be going into an election in 4 years' time saying to everyone, I'm sorry, but your dreams of retiring soon are going to have to be put off for a year or two? Yeah,
well, you talked about the summer holidays, didn't you? We may have a few more summer holidays as we gear up for maybe working to, 70 in Denmark. But don't they do like, what, a 30-hour week in Denmark?
Something like that. Yeah. And also contrast that with the French, who they sort of knock it off at about 50, don't they? Not really. About 62, but yeah. They're
very protective of their retirement age, aren't they? Bloomberg opinion columnist Rosa Prince, thank you very much indeed on maybe all of us seeing our pensions and retirement being pushed back a few years, at least here in the UK. Also making news, the White House says President Donald Trump was caught off guard by Israel's bombing of Syria. It comes amid reports the US president is increasingly concerned by Prime Minister Benjamin Netanyahu's aggressive military efforts. The remarks come after a statement from 28 countries, including Britain, Japan and several European nations, saying the war in Gaza must end now. The White House says it will remove the Wall Street Journal from the group of reporters travelling with the president on his upcoming trip to Scotland. This after the paper published a story alleging Donald Trump once sent a suggestive birthday letter to the late disgraced financier and sex offender Jeffrey Epstein. The president called the letter fake in a social media post. The Wall Street Journal has previously said they have full confidence in their reporting. The move comes days after Trump sued Dow Jones and Company, News Corp and Rupert Murdoch for libel over their report about the birthday letter. And Elon Musk's social media company X says it will resist what it calls a politically motivated probe by French authorities into alleged bias and manipulation of the platform's algorithm. In a statement, X said investigators have asked for access to its recommendation engine and data on user posts. Earlier this month, Paris prosecutors opened an investigation into suspected interference and fraudulent data extraction. Coming up, the latest tactic on Wall Street to help rich investors minimise capital gains tax liabilities. Our big take is next. This is Bloomberg. Welcome back. Microsoft rushing to roll out fixes for flaws in its SharePoint software after cybersecurity researchers and hackers have been able to steal sensitive information from governments and businesses. SharePoint is used by tens of thousands of organizations around the world to store and collaborate on documents. The US Department of Education is said to be among those targeted. Microsoft released a patch at the weekend, but is still working to fix other vulnerabilities. And BlackRock has told staff travelling to China for business trips to use temporary phones and not to take company laptops. It comes amid growing concern around travel to China after a Wells Fargo banker and a US Commerce Department employee were blocked from leaving the country. Let's bring in Bloomberg finance reporter Denise Wee for the details on this. Denise, what is the advice then that BlackRock is giving its team as they look to set foot in China?
So BlackRock has basically updated its travel policy. They haven't given a reason for this updates to the travel policy, but they've told their staff, not to bring laptops into China when they're going there for business travel, to bring loaner phones, and also not to use the iPhones or iPads, any company-issued iPhones, iPads, when they're visiting China. As I mentioned, they haven't given any reason, but this is happening as global firms are becoming more concerned about traveling to China and doing business in China at the moment.
Well, Denise, just expand on that. What specifically are the concerns? What's been going on that's led to this additional caution?
Well, I think we've seen, like recently, the Wells Fargo banker being subject to an exit ban. We don't have a lot of details on why she's been subject to this exit ban. There was also news of a U.S. Commerce Department employee that couldn't leave the country for several months. So we've seen a resurgence of these cases, and that's causing some concern among people visiting China, just about what's happening. And when these exit bans happen, there's often very little details, there's a lack of clarity, it often feels quite opaque. So I think that doesn't lead to reassurance among foreign fund managers, foreign banks that want to visit China for business.
OK, Bloomberg's Denise Wee, thank you very much indeed on the reporting, of course. And Denise was bringing that story to us and reported it out in terms of BlackRock and some of the restrictions they're putting on their staff, at least some of the warnings around taking hardware devices, mobile phones and laptops into China. Security concerns, of course, one of the factors, as Denise was saying. Denise, thank you. Now, with Wall Street at record highs in terms of S&P 500, NASDAQ, of course, wealthy investors also looking for ways to lower their capital gains tax bills. In the US, that has led to a rise in a creative solution, including one using ETFs. That's the subject of today's Bloomberg Big Take. Our cross-asset markets reporter, Justina Lee, who's been reporting on this for us and has led the reporting on this story, joins us now for more. Justina, talk us through this particular ETF tax strategy. This is a strategy for reducing your tax liabilities using ETFs. This story is very well read right now amongst our clients. What is behind this tactic?
So the most important thing to remember is that in the U.S., if you trade within an ETF, it often doesn't incur capital gains tax. And the reason for that is even when you're selling, let's say, NVIDIA, that's made you so much money, you're not selling it for cash. A lot of the time, the ETF is kind of swapping those shares with a market maker. And so increasingly, people have come up with this creative solution, which is that if you have a lot of appreciated stocks, you can just seed an ETF with those stocks. And once they enter the ETF, you can effectively trade them out kind of without paying your capital gains tax bill.
How popular is this method? How many people are taking advantage of, can we call it a loophole? This mechanism, how popular has this become?
So it's not very clear because these conversions are not labeled in any way, which I'm sure is kind of how the people like it. But, there are some clues here. For instance, I spoke to a lawyer that's really been leading the charge on these conversions. And he said he himself has worked on close to 100. And that's just been in the last few years or so. And kind of in terms of the ones we've been able to confirm, it does seem like there have been more. I know there's one coming this week that's going to be a few $100 million. And so it does feel like these are proliferating.
Are the regulators, are the tax authorities in the US, are they relaxed about this, or is it drawing scrutiny, criticism? How is this landing beyond the world of finance?
So these are all technically legal, and the reason is they're using kind of parts of the U.S. tax law that actually were not originally designed for ETFs, but they kind of have worked for the ETF structure. But for a lot of people, what's kind of been most controversial is that, so they're able to kind of swap out these assets when they're kind of meeting redemptions. But sometimes you don't have enough redemptions to kind of flush out these appreciated assets. So a lot of the time, the fund will arrange like fake inflows and fake outflows in order to kind of facilitate this mechanism. And I think this part has been pretty controversial.
Justina, as you're sitting around the desk right now, great piece of reporting, really worth our viewers' time as well. You can find out on Bloomberg.com, of course, and on the terminal. I did want to get your view, given your hat that you wear around cross-asset reporting for us, on the broader market themes that we're seeing right now. We've got the earnings story coming up, of course. We've seen that run up, the S&P 500 notching a 14th record high by the end of the close yesterday, year to date. A little bit more subdued in terms of the equity and stock action today. What are you and the team looking for in terms of what could be the next drivers, the next catalysts in the days ahead?
I think what's really interesting is the markets feel pretty complacent right now, right? So that's why in a lot of cases, like Netflix, for instance, even when they've beat expectations, you're not seeing a huge response in the market. And I think that's because investors have kind of priced in the fact that, Trump will chicken out and maybe also that Powell will chicken out, that ultimately we're going to get those rate cuts. And I think that's really been the focus of markets.
So we're thinking of Taco and Paco then. OK, Trump will chicken out, maybe Jay Powell will chicken out. He's certainly under pressure, isn't he, the Fed chair? US futures right now putting down by 0.1% on the S&P 500, of course. Bloomberg's Justina Lee, thank you very much indeed in terms of the big take of the day and what else is rippling through these markets. US futures then down 0.1% after the record gains of yesterday. Dow Jones futures currently flat. Nasdaq 100 futures looking to lose about 62 points. Tech as a sector has been a bit under pressure here in the European session as well. We have the big earnings stories really kicking through as well in terms of the tech story with Alphabet, with Tesla. Later this week, we have the auto sector as well reporting out of the US. So that will give you some indication in terms of the tariff pass-through, counting down, of course, to that deadline of August the 1st in terms of Trump's threatened tariffs on trade partners. Up next, it is a Bloomberg Brief. Stay with us. This is Bloomberg.